And joining me here on set, it is my pleasure to have two esteemed guests from our team. And joining me here from the Charles Schwab team, Kevin Gordon, head of macro research and strategy, Charles Schwab Center for Financial Research, and Collin Martin, head of fixed income research and strategy, Schwab Center for Financial Research. It's great to see you both. Thank you so much for being here. So Collin, I'll start with you. Just maybe a big picture thought on how we're going. We're near the end of the year. We've had a lot of sort of juggling happening and some fears in the market, but really we're only 2% off the high. Some of your thoughts?
Sure. If we take a step back, if we look at it from a big picture standpoint, and what we're looking at with the bond market is the economy still kind of chugging along? Is the labor market loosening? Is inflation rising or falling from here? And it looks like things have kind of cooled down a little bit right now, and that's been our thesis for a little while. We've had these 2 rate cuts so far, but we're a little bit more cautious about what the outlook is going forward. And I think some of the recent data, yes, we're still missing the official data, but some of the recent data that you kind of mentioned today that's causing the pickup in the stock market has been relatively encouraging. The ADP employment report was nice. It's not a full substitute for the non-farm payrolls report. And then the ISM services number was pretty good. So we saw a little pop in treasury yields right now, and that's kind of our outlook right now. Kind of hold steady for a little bit until we get more clarity about if the economy is actually slowing a little bit or if it's going to hold steady a little bit above trend.
All right, and Kevin, it's great to see you. I haven't seen you in a while as well. We think about what's going on here, and you talk about TINA even. Is that back?
Well, it's back for data. So there's no alternative for federal government data. So to Collin's point about being in this, data drought, there is a lot that we're missing in terms of having this impaired vision of, being able to see what the actual underlying fundamentals of the economy look like. But, to Collin's point about things like ISM services, it still underscores and emphasizes this pretty strong bifurcation that you're seeing in the economy, where areas like manufacturing, anything that's more cyclical oriented, that's still under pressure. So manufacturing has been in contraction for quite some time. All of the subcomponents are still relatively weak. There was a little bit of a pickup in things like new orders and employment, but they're still in contraction. But when you look at those same components and the peers on the services side, they were pretty strong this morning. Business activity, much stronger, new orders, much stronger. Employment still okay, but still in contraction, but the trend is getting a little bit better. So I think that's pretty much the central theme, has been the central theme for most of the post-pandemic era, but is still the central theme as we go into the end of the year. And even if you get a hit to GDP, which it's probably going to be the case that you do from the shutdown, potential to shave off a couple of percentage points of growth just for the fourth quarter, but you expect that to sort of bounce back as the government does reopen when that happens. But I think that's still the central theme, is this really strong bifurcation you've got between what has been working, which is services, but then what's also been struggling, which is manufacturing.
And I do want to talk about third quarter earnings season, where you said bending, not breaking. That's catchy, and I'd like you to explain that. But hold the thought for a moment. Collin, as we take a look here at the big picture and we look at what's going on when it comes to bonds, and you see the 10-year bond yield moving higher. I mean, it happened last time the Fed cut rates that in the end, the 10-year bond yield went higher. And look at us here again. What do you think when you think about for bond investors, what the Fed may do? What is the anticipation here for what happens in fixed income?
Well, it's important to kind of differentiate what the Fed funds rate is and what it impacts, and then how it flows through the other parts of the market. So we do expect the Fed to gradually cut rates from here. So that means short-term rates should continue to fall. So we're kind of highlighting that to our investors, our clients, that if you're in very short-term investments like money market funds, treasury bills, you'll probably see your income decline a little bit. You mentioned the 10-year yield, though. It's up a little bit over the past few weeks. It's kind of been holding above 4%. We think it's going to hold there for a little bit, even as the Fed cuts rates, for a few reasons, but the main reason is inflation. Inflation's still sticky right now. It's near 3%. We still have tariffs, which could maybe pull it up a little bit. So in an environment where inflation's still high, I think investors might demand to see yields stay elevated a little bit on the long end to compensate for the risk that maybe it reaccelerates from here. Now, we're not saying investors should go take too much interest rate risk, though. So what we're telling them is to focus on intermediate term maturities, maybe 5 to 10 years, as a good balance of risk and reward.
And people did so well with short-term bonds. I mean, that was, the glory days, I think. Tell me more about earnings season. Your thoughts here, Kevin.
So, the point about bending, not breaking, so much of the narrative around corporate earnings was that you were really going to start to see a lot more pressure in the second half of the year because of tariffs. I think for a host of reasons, probably most importantly the fact that tariffs have really been more of this slow drip post-Liberation Day rather than all of the rates that we saw on April 2nd just staying at that level. Clearly that hasn't been the case. So I think that's been a serious help. But also when you look at a lot of the stockpiling for companies and the fact that inventories are still relatively high, of course where they were compared to a few years ago, even compared to last year, they're still working down a lot of that inventory growth. At the same time that the stock of labor, to the point about ADP being relatively strong, we haven't seen a lot of layoff activity. It's still this low firing environment. Even though the hiring rate is basically pinned to a cycle low, the firing rate just has not picked up. Very unique spot to be in for the labor market, but that's kept the stock of labor relatively full, and we're still in mostly a fully employed labor market. So when you have all of that and income growth continuing to drive spending and inflation still under actual income growth, keeps real income positive, keeps real spending positive, ultimately accrues to the benefit of corporate earnings. So I think that's all painted the stronger picture of relatively resilient earnings that are, really bending. Again, not breaking under anything that's been tariff related, but we would say that paying attention to how much tariffs get passed now to consumers as we round the corner into 2026, which we think has to happen at some point, just because companies can't work on that inventory cushion as long. That's one thing we'd be watching for as we turn the corner.
So wonderful to have your perspective, General. I wish I could have you both on every day. So nice to see you both. Kevin Gordon, Collin Martin, thank you both from the Schwab Center for Financial Research. Kevin, Collin, thank you.